Welcome to another installment of the Whitaker-Myers Wealth Managers What We Learned in the Markets This Week video. We aim to provide you, our valued clients, with a brief video giving you information that is helpful to your understanding of the markets from a biblical worldview with no financial agenda, which makes us uniquely different from the news media in America. This video is for informational purposes only and should not be relied upon to make investment decisions. The clients of Whitaker-Myers Wealth Managers may maintain positions in the securities discussed in today's video. All opinions discussed are solely those of John Mark Young and not those of Whitaker-Myers Wealth Managers.
Hi, I'm John Mark Young. Now it's March Madness around America, but before college games this week started to kick off, we saw our first major upset of the tournament, the University of Kentucky getting the boot early. We saw this week the Federal Reserve raise the probability that interest rates at their current levels would be bowing out of the tournament a little bit early, or maybe out of the markets early. The CME Group, who we talked about last week, they had a 50-50 probability that the Fed would cut rates in June. Now, after this week's meeting, it's a 75% probability that we're going to cut rates at the June meeting. At the Fed's regularly scheduled meeting this week, Fed President Jerome Powell made it clear the recent inflation reads that have come in a little bit hotter, a little bit stronger than expected in the month of January, the month of February, have not deterred him and his Fed governors, his voting members, from thinking that rates are on their way down and the economy doesn't need to head into a recession to actually kill this inflation game here. He made mention that even though we got data we didn't like, such as the CPI and the PPI reports we talked about on this video series just last week, he doesn't believe that those data points have changed the overall story of the markets, the overall story of inflation, which is inflation is moving down, not in a linear fashion, not in a straight line, but its trajectory is down. And as long as it continues to trend the right way, we're good. Of course, interest rates affect everything from credit cards to car loans to home purchases to business loans and the rates we get on our savings accounts. And one catalyst for the markets to continue their momentum upwards is when we see rates start to come downwards. That should be a tailwind for the markets and in their favor for the rest of this year. Now, Joseph Davis, who's the chief global economist at Vanguard, he told the Wall Street Journal this week that he thinks that the Fed does decide to provide rate cuts throughout this year, it would be counterproductive, he says, to this final push to get inflation back to its 2% target. The last mile of the inflation game is getting it down from 3 to 2, maybe the hardest part of the fight. However, after today, Friday, March 22nd, when we saw a good amount of retail stocks sell off, companies like Nike, they're down 6%. Lululemon, how about them? They're down 15%. Estee Lauder was down 3%, all because fear of a slowing consumer. It seems that lower interest rates, Joseph, may not be something that these retailers are saying is going to drive the consumer to go buy more and buy. As a matter of fact, they might be tapped out. All the while, the markets love the fact that they got confirmation from the Fed that they are not thinking about delaying those interest rate cuts. We're still going to make them in June. And just some bad inflation numbers in January and February are not going to take us off that. Our research partner, FS Insights, has spent considerable time with us and their other customers advocating that the January and February numbers are more seasonal and that inflation is not coming back stronger, especially when we see that trend, that seasonal trend happening all over the world, not just America. So since the markets love the Fed's reaction this week, let's dive in and see how much it really helped. First, we look at the Atlanta Fed's GDP Now model, which shows us in real time the growth of the U.S. economy and what it's looking like. The number this week came after releases from the U.S. Bureau of Labor Statistics, the U.S. Census Bureau, and the above-mentioned Federal Reserve Board of Governors and their statement of economic projections. And the number came in at 2.1%. Now, 2.1% is less than what we've been seeing, but this is still good growth for the quarter, just not explosive growth. Hence, one data point giving Jerome Powell confidence the economy is okay. It's growing, but it's not too hot. Next, this week we saw mortgage rates come back up with the 30-year variation popping back up to 6.87 and the 15-year mortgage. That also came in higher at 6.21. That was only slightly higher, but higher than last week. Next, we look at the front end of the labor markets to see if the initial claims for unemployment, those going on unemployment for the first time because they cannot find a job and they may have lost their job, is creeping up at all. And these numbers, guess what? Same story, different week for a long time now. Very boring. 210,000, those are historically low numbers. And the continuing claims for unemployment insurance, those are staying pretty low. Those are people on unemployment, unable to get off of it, 1.8 million. And finally, let's look at the markets this week. The S&P 500, which of course is our proxy for growth and growth in income, but only when considered together, that was positive 2.29% this week. Over 2%, pretty good week for the S&P. The Russell 2000, which tracks small and mid-sized stocks or aggressive growth in our Dave Ramsey vernacular, that was positive 1.37% this week. And finally, the MSCI EAFE, which tracks stocks across the developed markets in the United States, or excuse me, in the world, not the United States, that was positive 0.93% this week. S&P 500 for the W. March Madness. Point number 2, the old adage of buy low and sell high applies to the market when you're looking to make a quick flip. You want to get in, you want to get out. You better go in low and you better go out high. But when you're in it for the long haul, what do you do? What do you do when the market hits an all-time high? All-time high. If the economy is doing well, you either buy more or you hold. You don't sell. If you've watched Fox Business or CNBC over the last week, there has been a theme that has dominated many of the conversations they've had with their guests. This is all around the market being at an all-time high, and there still hasn't been a big sell-off this year. With so many well-known economists predicting this massive sell-off, why hasn't it happened? Maybe because they're usually wrong. Economists, the only job you can be wrong and keep your job. Considering when we look at the technology sector, which has been the largest driver of growth in recent years, your growth funds, or a lot of what is inside of your growth funds, it has seen a pullback recently with Tesla down 30% year to date and Apple is down 11% year to date. So why does the S&P 500 index continue to rise even this week ending at 5234? Our external and internal research teams, led by the infamous Summit Puri, he's the man. I hope to have him on a video series on our YouTube channel very soon. But they've concluded that the continued rise of the market is primarily due to the strength of our economy and the rotation of sectors leading the change. Let me give you a quick example. My daughter's basketball team, they won a pretty big game recently. You know how they won? Our normal offensive player, she's good, she's amazing. She got her 10 points or whatever she averaged. But what happened in this game that went so well for us against a very good opponent, the bench came through, and the second best player got her normal 10 points additionally. And then we've had a great defensive effort. So we've seen a slowdown in the tech sector, who you might call our best player on the team. But now we've also seen the bench, financials, and healthcare. They've provided a necessary boost coming off of the bench for the S&P 500. With the next group coming out strong, the technology pullback we've seen has been a non-event, has not driven the market down, and we continue to see growth in the overall market. The S&P 500 is still up. This doesn't mean that technology is going to sit on the bench for the rest of the game, because that best player, they want to get back in. We anticipate more movement as the Fed's plan to continue to decrease rates, as we've talked about, probably 3 times this year. In conclusion, hold or buy more. When the markets are at all-time high, you do not want to sell. And if you're in the retirement game, you're saving for retirement, a buy and hold forever. Just ensure you've got the right asset allocation for how soon you need those distributions. And now point number 3. In the ever-changing world of real estate, staying on top of housing affordability trends is absolutely crucial. Let's explore what the latest data reveals about the February 2024 housing market. According to the National Association of Realtors, the NAR, there were 14.8% more houses for sale in February of 2024 than the previous year. This is a welcome, very welcome sign for potential buyers, especially first-time home buyers, as it indicates a potentially wider range of options, including some actual affordable options. The good news continues with the median sales price number that came out, and February's data showed us that there's a slower growth rate, in which was only 0.3 compared to the same time last year, with the median list price hovering around $407,000 and the median sales price around $384,000. This means that homes are becoming more affordable, at least, they're not increasing as rapidly as well as we saw. Of course, I own a home. I want it to increase. While these trends are encouraging, it's important to note that the inventory is still lower than pre-pandemic levels. So we're not back to where we were. This means there may still be a lot of competition if you're going out to buy a home amongst what is available. So what does all this mean for aspiring homeowners in this competitive market? Well, here are some tips from our phenomenal financial coach, Lindsay Curry. And as we asked her, what should we tell people as we talk about these February 24 home numbers? She said, hey, tip number one, get your pre-approval for a mortgage. This shows sellers you're a serious buyer, and it'll strengthen your offer when you make that offer. We recommend, of course, a 15-year mortgage that is no more than 1/4 of your take-home pay. Point number two, or tip number two, be prepared to act quickly. You can't sit, analyze, think. You got to be a mover. In this fast-paced market, homes can move off the market as quickly as a day. Tip number three, she said, hey, you better consider working with a buyer's agent. A buyer's agent can help you navigate this competitive landscape and craft an offer that will meet the needs of the seller because they know what sellers and buyers want. And finally, tip number four, she said, hey, don't be discouraged if you run into some initial rejections. Keep searching, stay positive. The power of positive thinking will also help you get the right home that is out there for you. And tip number five, don't get too deep and become house poor. Don't overspend because there's a lack of inventory out there. It's competitive. It definitely is competitive, but take your time, find the right house. You don't need to rush into this. And finally, point number four, in recent years, a concerning trend is emerging in the American automotive market, highlighted by a surge in car debt, and an increasing number of individuals owing significantly more on said car debt, auto loans, than their actual cars are worth. Like a rock, falling like a rock, baby. According to data from Bloomberg, this trend has intensified more recently, with more and more Americans finding themselves burdened by substantial debts linked to their automobiles. The average amount owed on auto loans has risen steadily, leaving borrowers facing a significant financial gap between what they owe on their car and the depreciating value of that vehicle over time. One of the primary drivers behind this phenomenon is the depreciation of used car values. The value of pre-owned vehicles has been declining, which is exacerbating the situation for those who finance their purchases with loans. As used car prices continue to fall, borrowers are finding themselves in a very precarious position because they're upside down on this auto loan. And of course, being upside down is when you owe more on the debt than the vehicle's market value. Thus, if I get in a car accident or if I need to get rid of this car or the engine blows out, I'm in trouble. This scenario not only complicates the prospect of selling or trading the vehicle, but it also increases financial strain as the borrower is going to struggle to bridge that widening gap between loan balance and the depreciating asset value. And that asset value does not, it keeps going down like a rock. This is leading to a rise in auto delinquency rates and an increasing number of borrowers defaulting on their loans. The combination of mounting debt, depreciating vehicle values, and economic uncertainties around some things might be pushing borrowers into distress, with them unable to keep up with their loan payments, hence why we're seeing a large amount of increases in auto delinquencies. Interesting, we don't have mortgages delinquent, but it's the auto loans that we're seeing a rise in delinquencies. Not at a precarious level where it's detrimental to the economy, but if you're an auto lender, you are probably worried a little bit about it. A lot of our small and local credit unions have shifted more of their lending specifically to auto loans as the housing market has become harder for them to finance, and more of it has just become mortgages that get sold and sold and sold. And so those are the banks that potentially could be hurt by the fact that the auto industry or the auto lending industry is seeing some stress right now. All the while, this is why you should work the 7 baby steps that Dave Ramsey and the team at Ramsey Solutions teaches. Those 7 baby steps are going to make sure that you stay out of debt, you live on a budget, you build a sinking fund so that you don't have to borrow the next time you go to buy a car. And guess what? A car that has no debt never is underwater. Unless, of course, you drive it in the lake. And then that's just more on you. Remember, Michael Scott did that in The Office following the GPS. You don't want to probably end up like Michael Scott in most situations. So follow the baby steps. And that's why we would encourage you to like and subscribe to our videos, because we follow the baby steps and we teach the baby steps. So when you like our video, it pushes our content out to more people. And when you subscribe to our video, it allows you to get our content as it's pushed out, including our webinars A recent webinar we just did was with our friends at PIMCO all around the fixed income markets. It was one you don't want to miss, so check out our YouTube video and see how that webinar went. As well as you can go to the comment section of this video and you can schedule a meeting with our financial coach who will help you in baby steps 1, 2, and 3, get out of debt, stay out of debt, live debt free, get on a budget, hold you accountable to that budget, as well as you can meet with any of our financial advisors and planners who will help you in baby steps 4, 5, and 6, and they're going to help you build out that retirement plan. They're going to help you figure out how to pay off that house early and save for your kids' college, as well as maybe do some bridge accounts, anything else you want to do, so you can get to baby step 7, where you get to live and give like no one else. Thanks so much. We'll look forward to seeing you next week.